this morning. I'm Austin Small. I'm the Director of Legal and Regulatory Affairs here at the Association. We're going to kind of do a brief overview of South Carolina's tax structure and the need to reform associated with it. The basis of this report is that we had, along with the State Chamber, had the Tax Foundation, which is a large think tank in DC, kind of do a comprehensive look at our state's tax structure, the strengths, the weaknesses of it, and some areas of improvement. And so I'm kind of taking as opposed to you having to read the almost 200-page book, this is sort of an overview synopsis of it. If you have any questions throughout the webinar, feel free to put those in there, and we will go over those at the end. So the first thing is kind of figuring out with our tax reform is where exactly do we get all of our state tax revenue from? So if you kind of look at this first one here, we get about 47% of all of our state revenue from taxes. Then we get about another 39% from the federal government. And then we still have some smaller areas like departmental services, licenses, fees, interest income, and all of that is maybe about a quarter. But about half of all of our state revenue comes from taxes. So once we get into exactly what makes up those particular taxes, you see about 42% is individual income. Another third is our sales tax. And then we have things like motor fuel sales, licenses. You look at corporate income is actually only 4%. And then insurance premium, other taxes. But if you kind of look at it, we really have about 3/4 of all state tax revenue comes from either individual income or general sales tax, which is why those have been sort of the two buckets that the House in particular has really looked like they're going to tackle first. So as we saw, only about 4% of all tax revenue in the state is corporate income tax. And the main reason for that is that we have a single rate system of 5%, but it's loaded with incentives and credits. In fact, 89% of all filers in the state do not end up paying a corporate income tax. Some other issues with our corporate income tax structure is we currently do not allow for net operating losses carrybacks, and we only have a 20-year carry forward provision. This really hurts cyclical industries that have highs and lows. It doesn't allow them to essentially be able to write off the bad years to help with their higher years. A couple other things. When we did late last session, South Carolina did some conformity to comply with the 2017 Federal Tax Cuts and Jobs Act. One of the things they did not do with it is the federal law allowed for full expensing of equipment. This was really to help new businesses be able to write off immediately, new equipment, to kind of spur manufacturing and capital investment. And the South Carolina did not conform to that provision. The other thing that we have is we inconsistently treat goods and services with our single factor apportionment. So a good example would be you have a company that is located in South Carolina or outside South Carolina, but they only sell 10% of their goods into South Carolina. They're actually only taxed on that 10% as opposed to everything. Now, likewise, you have a company, maybe an accounting firm, a law firm that is based in South Carolina. They are taxed on 100% of the services, even if it helps outside of the state. We mentioned earlier, part of the reason that only about 11% of filers have a tax liability is we have lots of corporate tax credits in the state. In fiscal year 2016, we had over $115 million worth of claimed corporate tax credits. Given the small size of this is not something, at least at the State House, that we've really heard as being a high priority for the legislature to move on at this point. Individual income taxes. This we do have a problem. We have the top marginal rate in the region of about 7%. Important thing to remember with individual income taxes is that's not just individuals. That also includes LLCs, S corporations, partnerships. So that's really where a lot of businesses end up actually paying at the individual income tax rate instead of the corporate rate. As we showed earlier, it's about 42% of all of our state tax revenue. So this is our single largest source, which is why any meaningful tax reform is going to have to hit this issue. The other problem we have in the state is we have a two-part system. We either have individuals who are paying that top marginal rate of 7%, or they're paying no income tax whatsoever. In fact, about 55% of all state income tax revenue came from only 7.5% of returns. About 42% of individuals don't even pay state income tax. And then 99.8% of all the tax liability in the state came from the top half of returns. So the legislature has especially been looking at something that's going to lower our rate. So we're no longer the top marginal rate of 7%. We're more competitive regionally, but also expands the base so we don't have essentially half the state not paying anything and half the state paying a really high rate. One of the other issues that we have is we have identical brackets for single and joint filers. So it sort of creates a marriage penalty. Now we do have a marriage credit in the state, but it is capped at $350. So it really it disincentivizes individuals to file jointly, which has advantages on the federal level, but at the state level, they're taxed the same whether it's a single or joint, and that $350 max credit doesn't really help offset that. The last thing that there's an issue is that we have the earned income tax credit, which is a good policy to kind of help those on the lower end to kind of offset any tax burden. Unfortunately, the state, the way that they have written the law, this is ultimately our state earned income tax credit is going to reach 125% of the federal credit. To put that in context, that's going to be about 2.5 times larger or more generous than the next largest state, and it's going to be about 40 times larger than the least, least progressive state. So that is something that any reform would have to look at, of kind of making that credit much more appropriate. So we kind of get into the next big bucket of state tax, which is our sales and accommodations tax. So we do have a 6% state rate with allowances for local tax options. Of that 6%, 4% goes to the general fund, 1% is for education, and 1% is the homestead, which was part of the Act 388 compromise. We do have a very limited tax base that predominantly relies on goods. That's the main problem with our sales tax. Our sales taxes, it's kind of built on an economy from a few years back where we were much more goods centric as opposed to highly relying on services. In fact, of the 176 services that we could potentially tax in the state, we only tax 39. To put in kind of comparison with our state of having a very limited tax base, in 2017, the state had a consumption of $169 billion. Had we paid sales tax on all of that, that would have been about $10.2 billion, which is actually 3 times what we actually received in sales tax. In fact, alone, we have $1.8 billion that are forgone by exempting consumer goods. Of course, one of the reasons for that is inside of that consumer goods category is prescription drugs, which is obviously not something the legislature has a whole lot of appetite towards touching. The other issue we have is that about 37% of all sales tax are paid by businesses, which leads to pyramiding. So you have an issue where a business pays sales tax on a particular widget that they buy that then is going to be included in the final product that they sell, which will also have sales tax. So you end up getting a double taxation, which is obviously something that we don't ever approve of. In fact, 17% of all business taxes in the state are sales taxes. But our biggest issue that we have a sales tax, and something that the legislature has been looking at, is that we essentially don't tax nearly enough products, which is why we have to compensate with a fairly high sales tax rate. So right now we're capturing as a state about 28% of all potentially taxable goods, whereas in the national average is about 38%. So we are well below the national average. Of course, as an association, one of the things that we're going to have to be very mindful of is anytime they're looking to expand what they can tax, especially in the services sector, would be our real estate commissions, which is something which was just tossed out last session and was pretty much immediately pushed back on by us and a number of other groups. But they're kind of looking at this. The proposal that was given to us through the tax foundation has stuff like including tax preparing services, consumer repairs, internet access, household maintenance, a lot. There's a good number of things that we don't currently tax. They listed out here about $5.5 billion worth of different services that we don't tax, and depending on which option they showed us, we could get anywhere from about 2.7 billion of that back to about 500 million. So the thing that's kind of most near and dear to our hearts is property taxes. So while this doesn't come up as a lot with the state tax collection, this is about 77% of all local tax collection, and about 72% of all local revenue. Now that share has been falling since the 1990s, even with the passage of Act 388, which was somewhat surprising. We do have an effective rate of about 0.55 on our property taxes for primary homes. The biggest issue we have is the 6% assessment ratio, which does have an outside effect on lower income individuals, young people, and seniors. It kind of disincentivizes, second homes, relocations. Also, when you get into things like apartments, we actually, among all major cities, have the second highest ratio of property taxes paid for an apartment versus a primary traditional owner-occupied residence. The only major city with a higher ratio than the Columbia, South Carolina is New York City. Once we also have, along with this, so we realize that we have some issues with property taxes, the legislature has put in both assessment and millage limits. This, of course, has led to less local revenue. So when you cap it one way with property taxes, saying that you can only assess so much or have a millage of a certain limit, that leaves local jurisdictions to do things that we're seeing in the rise of, such as impact fees, local taxes. So they're going to get the funds one way or the other. So while these assessment and millage limits have noble intentions, they sometimes don't have good effects. And then kind of the elephant in the room when we get to property taxes is Act 388. Sort of in a nutshell, this was the act that said that the school operating cost portion of a millage is paid by non-owner occupied properties and not owner occupied properties. This is obviously part of the reason that it's about a 3 multiple, 3 to 6 multiple on property taxes for a non-owner occupied versus an owner occupied. So the legislature obviously agrees and has a lot of belief that Act 388 either needs to be completely reformed or repealed or reformed in some sense, but how to do that is easier said than done. But certainly property tax is something that they're looking into, maybe not initially with doing the sales and income tax, but obviously the big thing they're pushing right now at the state legislature is education reform. If they were ever to get into the funding mechanism, things like Act 388 and property taxes would surely accompany that. So to kind of put another thing in perspective of property taxes, so we do have a couple different assessment ratios in the state. We obviously have the 4% on primary owner-occupied, which is consistently one of the lowest in the country, if not the lowest. It's definitely in the top 5. But on the other hand, we have a very high rate on industrial manufacturing property. So to give an example, if you were to have a $1 million industrial property in Charleston, the effective property tax rate of that would be about 2.28%. To put that in comparison to some of the markets that we compete with, if you were to locate that same $1 million property in Charlotte, you're looking at a 0.91% rate. Or if you were to locate it in Atlanta, you're looking at a 1.47%. And nationally, the average is about 1.5%. So we're almost a good 0.75 higher than the national average, which really disincentivizes us, leads us to do things such as fee and lose, and kind of have to work around our problems on our tax system. Something you're also aware of that would be thrown in here would be business license taxes. The problem with this state is we have a very highly complex system with high compliance costs. We also don't have consistent standards. So what one jurisdiction considers something that is needing a business license, the other jurisdiction does not. I think there was an example they gave in this book that donuts are taxed or there's a business license that's the same whether or not you're baking donuts or selling donuts, but where if you're doing ice cream, there's a different license fee for if you are making ice cream or selling ice cream. So it's a very complex system. There's also reliance on gross receipts. The problem with gross receipts is that it penalizes those new firms or those with narrow profit margins. So if you have a new firm that has, has a lot of initial capital investment that they have to do, so they're really not making a whole lot of net, but they maybe have some high gross receipts. They're actually going to pay the business license fee on the gross receipts. Getting even further, gross income is not actually defined by law, and it's kind of up to the individual jurisdiction. So this can also lead to some double taxation because we get into how exactly did this gross receipts, and maybe the same receipt is being taxed for multiple different brokerages or different areas. So now that we kind of understand the issues with our tax system, the Tax Foundation laid out about 4 different options. Just as a general, these were some kind of broad concepts. As you'll kind of see, some are much more theoretical than practical, but it sort of shows where our different options would be. So option A would be a full repeal, would include a full repeal of the corporate income tax and the corporate license fee. A corporate license fee is different than the license fee or business license fee we just talked about. It's sort of a system that charges money for stocks on a corporate license fee basis. It's something that very few states have had, and it's an antiquated system. That's something that they've consistently recommended through all options. Option A would lower that income tax from 7% to about a 4% single rate, keeping in the $12,000 standard deduction and personal exemption, which is part of the new federal Tax Cuts and Jobs Act. 4%, it seems, based on what we've heard down at the legislature, a little ambitious. They're kind of looking at something more in the high 5 to low 5%. So 4% is obviously something much more ambitious than was likely to occur. Going into that earned income tax credit that we talked about earlier, they would propose freezing it at 2018 levels. They would reduce the sales tax from 6% to 5.25%. They would gradually phase all the school operating costs back into owner-occupied. Once again, that's something that's probably easier said than done, and would obviously have to probably be accompanying any education reform. And then ultimately phasing down a non-owner occupied assessment ratio to match the owner-occupied assessment ratio in the state of 4%, and then moving manufacturing and industrial to 6% from right now their 10.5% or 9% ratio. Option B is a little less ambitious. It does have that full repeal of corporate income tax and license fee that option A had. It makes the individual income tax rate 4.75 with the same $12,000 standard deduction, personal exemption. Also, the state of South Carolina has a separate personal exemption for individuals under, I believe, age 6. It would freeze that earned income tax rate at 2018 levels. It would expand the sales tax base to offset reductions in appeals. Obviously, that's where different groups would have to sort of fight for their particular exemption in the law as it stands. This would also phase back in the school operating cost, and then this would all match the phasing down to the 4% and 6%. Option C, from at least our vantage point, is probably at least a structure that is probably most closely aligned with what would actually occur. This will lower the corporate rate to 4%, but still repeal that license fee. Lower that individual income to 5%, which is much more in line with what the legislature is sort of feeling at this point. It would freeze that earned income tax rate. It would do some modest sales tax broadening. Nothing crazy, sort of kind of get the low-hanging fruit into our tax base. It would replace the local school operating millage with a statewide revenue source, so some additional tax, and kind of create a statewide millage as opposed to a local millage. And then phasing down the manufacturing and industrial property at 6%, but still keeping non-owner occupied at 6%, but essentially only having 2 assessment ratios in the state, either 4% or 6%. Option D would do nothing on the corporate income tax, but it would repeal that license fee. Would be about 5.2% on individual income with the same deductions and personal exemptions. would freeze that earned income tax credit at 2018. All it would do on the sales tax things, it would tax recreational services and emissions, which are things that we don't currently tax. It would phase down manufacturing industrial to 8%, as opposed to the 9.5% or 10% that it is now. And then it would create a single point of collections and administration for business license tax and create forms to eliminate tax pyramiding, which is likely something that could be thrown into any of these options. So to kind of show what these different options would do to our current tax structure and where we kind of rank nationally, kind of have this graph to show. So right now, and you want to be closer to the left than the right on this particular chart. So right now, based on business tax climate, we're down the mid 30s, especially on individual and sales tax, which I said that makes up a large part of our tax revenue. So to kind of show if we were to go to adopt option A, as proposed by the Tax Foundation, this is what would happen. We would go all the way much lower. Now, of course, the corporate tax would be almost at zero because once again they eliminated the corporate income tax. Individual will be in the top 10 because of the we've essentially almost cut it in half. Sales tax would be much more manageable, but this would also include taxing a whole lot of goods and services that are not currently taxed and we may not want taxed. But then the property tax would make that much more competitive. Now, option B, this is when we kind of don't make as drastic of changes. You really see nothing changes except for that sales tax. And once that's set, any change in the sales tax is really how much of that $5.5 billion that we're not currently taxing do we want to put back in the system, understanding that every single one of these things that has an exemption has someone fighting for its exemption. This would show option C. Like I said, the individual still keeps around that 10. The corporate goes back up to 10 because we've no longer eliminated it. We simply reduced it. But once again, corporate income tax in the state is not a huge piece of the pie. And then option D, which is sort of just doing a reform around the edges, kind of keeps everything the same. Corporate goes up a little bit, and then sales pretty much stays at where we are now. So with that being said, I'll kind of take the remaining time to answer any questions that anyone may have. Yeah, so this is recorded. It will be available on our YouTube page. If anyone has any questions now, I'll be happy to answer them. Otherwise, I will provide my contact information, and I'm happy to go into as much detail as you would like about this. A couple of things based on what we're seeing down at the legislature. The House has been having a few meetings with their committee chaired by Tommy Pope, and they are looking to have a proposal probably at the beginning of March, and that will include a sales and income tax element probably put together. And then the Senate that is led by Senator Bennett hasn't had any, we haven't heard any deadline, but I imagine that it will be going along the same lines. Okay, does not look like we have any questions. So there's my contact information if anyone needs it. If not, then we will go ahead and close out. And if anyone has any, like I said, feel free to email me or call me with any feedback.